Why do some people become financially successful, while others, despite working hard and earning a good income, continue to struggle with money? The book is not presented as a traditional textbook on finance. Instead, Kiyosaki tells the story of two father figures who shaped his understanding of money in completely different ways. One was his biological father, whom he calls his poor dad, and the other was the father of his childhood best friend, whom he calls his rich dad. Both men were intelligent, hardworking, and successful in their own ways, but their beliefs about money were almost completely opposite. Kiyosaki's biological father was highly educated and believed strongly in education, getting good grades, finding a secure job, and working hard. He wanted his son to follow a conventional path, study seriously, obtain a good qualification, get a stable profession, and work for a respectable company. His advice came from a place of genuine concern. He believed that financial security came from having a reliable job and a steady salary. Rich Dad, however, looked at money from a completely different perspective. He did not focus primarily on academic qualifications or employment security. Instead, he believed that people should learn how money works. He taught Kiyosaki that becoming financially independent required financial education, an understanding of assets and liabilities, and the ability to make money work for you rather than spending your entire life working for money. The contrast between these two fathers becomes the foundation of the entire book. Kiyosaki explains that his purpose is not simply to say that one father was good and the other was bad. Both men cared about him and gave advice based on what they believed was right. The important difference was their attitude toward money. One taught him to seek a secure paycheck, while the other taught him to understand the system that produces income and wealth. This background leads directly into the first major lesson of the book: the rich don't work for money. The first chapter begins with Kiyosaki remembering his childhood and his desire to understand how rich people become rich. When he was young, he and his friend Mike became fascinated by the idea of becoming wealthy. They noticed that some people had much more money than others and wondered whether there was something that rich people knew that ordinary people did not. Instead of simply accepting the financial circumstances around them, the boys decided to ask an important question: how can we become rich? Their first attempt was childish but revealing. They tried to make money by producing homemade counterfeit coins out of toothpaste tubes. They melted down the metal from toothpaste tubes and attempted to create imitation coins. Their experiment obviously failed, but it represented something important. They were looking for a way to create money rather than simply earn it through employment. Rich Dad heard about their experiment and used it as an opportunity to teach them a lesson. Rather than giving them a direct answer about how to become rich, he told them that they should learn to make money themselves. He eventually offered to teach them, but his teaching method was very different from what the boys expected. Rich Dad gave Kiyosaki and Mike an extremely low-paying job in one of his stores. The boys worked for a small amount of money, and Kiyosaki soon became frustrated. He felt that the compensation was unfair. He was working hard but receiving very little in return. Eventually, he became angry and went to Rich Dad to complain. This moment becomes one of the most important parts of the chapter, because Rich Dad deliberately uses Kiyosaki's frustration as a teaching tool. Kiyosaki expected Rich Dad to increase his wages. Instead, Rich Dad asked him whether he wanted to continue working for money. The question forced Kiyosaki to think differently. He realized that he had automatically assumed that the solution to his problem was to earn more money. Rich Dad wanted him to understand that this way of thinking could keep people trapped in a cycle for their entire lives. Rich Dad explained that many people follow a predictable pattern. They work, receive a paycheck, spend the money, become worried about not having enough, and then work even harder to earn more. As their income increases, their expenses often increase as well. Instead of becoming financially free, they become increasingly dependent on their salaries. Kiyosaki describes this as a kind of rat race. A person gets a job because they need money. Once they receive money, they use it to pay bills and buy things. Then they need another paycheck to pay for the next round of expenses. The person may receive promotions and salary increases, but the underlying pattern does not necessarily change. The problem, according to Rich Dad, is not simply that people earn too little. The deeper problem is that many people have never learned how to think about money. This is where the chapter introduces one of the central ideas of the entire book. Fear and desire can control financial decisions. People are often afraid of not having enough money. Because of this fear, they accept jobs they dislike, work long hours, and remain dependent on their salaries.
At the same time, the desire for a better lifestyle encourages them to buy larger houses, better cars, expensive clothes, and other possessions. The combination of fear and desire keeps them moving in the same cycle. Kiyosaki learns that simply earning more money does not automatically solve this problem. If a person has poor financial habits, a higher income can simply lead to higher expenses. The person may appear wealthier from the outside while remaining financially dependent underneath. Rich Dad therefore encourages Kiyosaki to develop a different relationship with money. Instead of allowing money to control his decisions, he should learn to control his response to money. One of the most important lessons Kiyosaki receives is that people should not make financial decisions purely because they are afraid of losing money or because they want to satisfy immediate desires. They should learn to think rationally, identify opportunities, and develop financial intelligence. This lesson is particularly significant because it challenges the conventional belief that the safest path to wealth is simply to find a good job and remain employed. Kiyosaki does not argue that employment is necessarily bad. Rather, he argues that employment alone does not teach a person how to become financially independent. A salary provides income, but financial education teaches a person how to manage, invest, and grow that income. The chapter also explores the difference between working for money and learning how to make money work for you. Someone who works only for a paycheck can become dependent on the employer. Someone who understands assets, investments, and business can gradually build sources of income that do not depend entirely on their daily labor. This is the philosophical foundation of the book. Kiyosaki wants readers to question the assumption that the ultimate goal of work should be a bigger salary. Instead, he suggests that work can also be a way to gain skills, knowledge, and experience. A person might work not only to receive money, but also to learn about sales, management, accounting, communication, investing, or entrepreneurship. This idea becomes especially clear when Kiyosaki describes the different attitudes of his two fathers. Poor Dad emphasizes the importance of job security. Rich Dad emphasizes financial independence. Poor Dad thinks in terms of employment, while Rich Dad thinks in terms of ownership and opportunity. The chapter therefore asks readers to examine their own assumptions. When someone says, "I need a higher paying job," are they actually solving their financial problem? Or are they simply trying to escape the immediate pressure of their expenses? When someone receives a salary increase, do they use the additional income to build assets, or do they immediately increase their spending? These questions are at the heart of Kiyosaki's first lesson. The deeper message of the chapter is not that money itself is evil or that people should refuse to work for wages. Instead, Kiyosaki argues that financial freedom begins by changing the way we think about money. A person who is constantly driven by fear and desire can remain trapped even if their income becomes quite high. A financially educated person, on the other hand, can begin making decisions based on long-term goals rather than short-term emotions. By the end of the chapter, Kiyosaki has learned that his childhood question, "How can I become rich?" cannot be answered simply by finding a high-paying job. The more important question is, what can I learn about money so that I am no longer completely dependent on a paycheck? That shift in thinking is the real beginning of his financial education. Chapter 1 therefore establishes the central foundation of Rich Dad, Poor Dad. The goal should not merely be to earn money, but to understand money. Kiyosaki wants readers to recognize the psychological cycle of fear, desire, work, and consumption that can keep people financially trapped. He presents financial education as a way to break that cycle. The chapter is ultimately about much more than becoming rich in the traditional sense. It is about developing the courage and knowledge to think differently. Rich Dad teaches Kiyosaki that money should be treated as something to understand rather than something to fear. Instead of constantly asking how to earn more, a person should begin asking how to create assets, develop valuable skills, and build financial independence. This first lesson sets the tone for everything that follows in the book. Kiyosaki's journey begins when he realizes that working harder for money is not necessarily the same thing as becoming financially free. The real transformation begins when a person learns to think beyond the paycheck and starts understanding the rules of money.
Robert Kiyosaki moves from the question of how people earn money to a much more fundamental question. What do people do with the money they earn? He argues that earning a high income does not automatically make someone wealthy. A person can have a large salary and still struggle financially if they do not understand how to manage money. According to Kiyosaki, the real difference between financially successful people and financially struggling people often comes down to financial literacy, the ability to understand money, assets, liabilities, income, and expenses. Kiyosaki continues to compare the lessons he received from his two fathers. His poor dad believed strongly in education. He encouraged Kiyosaki to study hard, get good grades, obtain a secure job, and build a respectable career. His advice reflected a common idea. If you become highly educated and earn a good salary, you will eventually become financially secure. Rich Dad agreed that education was important, but he believed that traditional education was incomplete. Schools taught children many useful subjects, but they often did not teach them how to manage money. A person could graduate with excellent academic qualifications and still have no understanding of how to build wealth, manage debt, invest intelligently, or distinguish between an asset and a liability. This becomes one of the most important ideas in the chapter. Kiyosaki explains that many people spend years learning how to become good employees, but very little time learning how to become financially intelligent.
They may understand mathematics, science, history, or professional skills, yet they may not know how their own financial statement works. They may earn money every month without understanding where that money goes. Rich Dad wanted Kiyosaki to learn to read financial statements. He believed that this was one of the foundations of financial literacy. A financial statement shows where money comes from and where it goes. In simple terms, it allows a person to see income, expenses, assets, and liabilities. This may sound like a basic accounting lesson, but Kiyosaki uses it to explain a much larger difference between the rich and the poor. The central concept he introduces is the difference between assets and liabilities. Kiyosaki defines an asset as something that puts money into your pocket, while a liability takes money out of your pocket. This is a simplified definition, but it is the foundation of the way he wants readers to think about personal finance. For example, an investment that regularly produces income could be considered an asset. On the other hand, a loan requiring regular payments is a liability. Kiyosaki argues that people often become financially stressed because they accumulate liabilities while believing that they are accumulating assets. One of his most famous examples concerns a house. Many people consider their home to be an asset simply because they own it. Kiyosaki challenges this assumption by asking readers to look at what the house actually does to their cash flow. If the house requires mortgage payments, taxes, maintenance, insurance, and other expenses, it may be taking money out of the owner's pocket rather than putting money into it. The important lesson is not that owning a home is necessarily bad. Rather, Kiyosaki wants readers to stop judging financial decisions simply by looking at what they own. Instead, they should examine cash flow. This distinction becomes extremely important because appearances can be misleading. Someone may drive an expensive car, live in a large house, and wear expensive clothes, giving the impression that they are wealthy. However, if those possessions are financed through debt and require large monthly payments, the person may actually be financially fragile. At the same time, someone else may live a relatively modest lifestyle while quietly building investments in income-producing assets. From the outside, that person may appear less wealthy, but financially may be in a much stronger position. Kiyosaki uses this comparison to show why financial literacy matters. Without financial knowledge, people can make decisions based on appearances. They may buy things because society tells them that successful people should own those things. They may take on debt because they believe a higher income will eventually solve the problem. But without understanding cash flow, they can easily become trapped. The chapter also introduces the idea of the financial statement as a kind of map. Kiyosaki wants readers to understand that money has a direction. Income enters a person's financial life and then it moves toward expenses, liabilities, savings, or investments. If most of the money immediately disappears into expenses and debt payments, the person has little opportunity to build wealth. The wealthy, in Kiyosaki's explanation, focus on acquiring assets that generate income. Over time, those assets can produce additional money, which can then be used to acquire more assets. This creates a cycle in which money begins working for the person. The financially struggling person, by contrast, may depend almost entirely on earned income. When the salary arrives, it is quickly consumed by expenses. If the person wants something expensive, they may borrow money to buy it. Their income then has to support both their normal lifestyle and their debt. This is connected to the first chapter's idea, the rat race. Chapter 1 explained how fear and desire can keep people working for money. Chapter 2 goes deeper by showing how a lack of financial literacy can keep the cycle going. A person may receive a salary increase and believe they are becoming richer, but if their lifestyle becomes more expensive at the same time, their financial position may not improve. They may purchase a bigger house, a more expensive car, or take on additional loans. Their income increases, but so do their liabilities and expenses. Kiyosaki calls attention to this pattern because it is easy to confuse income with wealth. Income is the money you receive. Wealth, in Kiyosaki's framework, is connected to how effectively you use that income to build assets and financial security. A person with a high income is not automatically wealthy. Likewise, someone with a moderate income can potentially become financially stronger if they consistently control expenses and build productive assets. This is why Rich Dad repeatedly emphasizes financial education. For Kiyosaki, financial literacy is not simply about knowing how to calculate numbers. It is about understanding the relationship between money and decisions. It means knowing what happens to your money after you earn it. It means understanding debt, investments, taxes, expenses, and cash flow. Most importantly, it means being able to look at a financial decision and understand its long-term consequences. The chapter also raises an uncomfortable question about the education system. Kiyosaki argues that schools traditionally focus heavily on academic and professional education while giving comparatively little attention to personal finance. Students may be taught how to become doctors, engineers, lawyers, or employees, but they may not be taught how to manage the money they eventually earn. As a result, someone can spend years preparing for a career without preparing for financial independence. This does not mean that Kiyosaki believes professional education is useless. In fact, he repeatedly recognizes the value of learning. His argument is that financial education should be added to traditional education, not necessarily replace it. A person needs professional knowledge to earn an income, but they also need financial knowledge to manage that income intelligently. This distinction is particularly important because income can disappear very quickly if a person does not know how to manage it. A talented professional can earn a substantial salary and still live from paycheck to paycheck. Another person with a smaller salary may gradually build financial security because they understand how to save, invest, and control their liabilities. Kiyosaki also emphasizes that financial literacy should begin early. Children often learn about money indirectly from watching their parents. If parents constantly talk about money as something they never have enough of, children may develop a similar fear. If children see their parents using debt carelessly or spending without planning, they may consider those behaviors normal. Rich Dad's approach is different. He wants Kiyosaki to learn by observing real financial situations and thinking about the consequences of financial choices. The lesson therefore becomes personal. Kiyosaki is not simply learning definitions from a book. He is learning to look at everyday life through a financial lens. A house is no longer simply a house. He asks what it costs and whether it produces income. A car is no longer simply a symbol of success. He asks whether it creates an expense. A salary is no longer simply a reward for work. He asks how that income can be used to build financial independence. This change in perspective is the real purpose of financial literacy. By the end of Chapter 2, Kiyosaki has established a principle that remains central throughout Rich Dad, Poor Dad. Wealth begins with understanding. Before a person can make better financial decisions, they must learn the language of money. The chapter encourages readers to stop measuring financial success by salary, possessions, or appearances. Instead, they should learn to examine their financial statements and understand whether their money is moving toward assets or being consumed by liabilities and expenses. The most important lesson is that financial freedom is not created simply by earning more money. It is created by knowing what to do with the money you earn. Rich Dad's message is therefore both simple and challenging. If you want to improve your financial future, do not focus only on increasing your income. First, increase your financial intelligence. Learn how assets and liabilities work. Understand your cash flow. Study how money moves. Once you understand those principles, you can begin making decisions that allow your money to work for you, rather than spending your entire life working for money. Chapter 2 thus builds naturally on Chapter 1. The first chapter teaches that people can become trapped by the desire for money and the fear of not having enough. The second chapter explains that financial literacy is one of the tools that can help them escape that trap. The goal is not simply to become richer in appearance, but to become financially stronger in reality. In Kiyosaki's view, the journey toward financial independence begins when a person stops asking only how much money do I earn, and starts asking what is my money doing for me. That change in question represents the beginning of financial intelligence, and ultimately the beginning of financial freedom.
The third major lesson moves the discussion from understanding money to understanding where your financial energy should be directed. After learning that financial literacy is essential and that assets should ultimately help put money into your pocket, the next question becomes, what should a person actually focus on if they want to become financially independent? The answer is simple, but surprisingly difficult for many people to accept. Build and manage your own asset column. This idea begins with a distinction between a person's profession and their business. Most people use the word business to describe the job or profession through which they earn their living. A doctor may say that medicine is their business. A teacher may think education is their business. An engineer may consider engineering their business. But the lesson presented here asks people to think differently. Your profession is what you do to earn your income. Your business is what you build for your financial future. This distinction is important because a person can spend their entire life working in a profession without ever building real financial independence. Someone might have a successful career, receive regular promotions, and earn a comfortable salary, yet still depend completely on that salary. If they stop working, their income stops. In that situation, their profession may be successful, but their personal financial foundation may remain weak. The idea is not to suggest that people should abandon their jobs. Instead, the lesson encourages people to keep their profession while simultaneously building their own business. Imagine someone who works as an employee and receives a monthly salary. Their job provides income, but after paying rent or a mortgage, food, transportation, bills, and other expenses, very little may remain. If every increase in income is immediately consumed by an increase in lifestyle, the person's financial position may never fundamentally change. Now imagine that the same person begins using part of their income to acquire assets. They might gradually build investments, intellectual property, real estate that produces income, businesses, or other income-generating resources. Their salary is still their primary source of income, but over time they are building something that belongs to them financially. That is the meaning behind the idea of minding your own business. The central message is that people should not confuse their job with their financial future. A job can pay the bills, but the assets you build outside your job can eventually provide financial independence. This way of thinking also changes how a person looks at their monthly income. Instead of asking only how much they can spend, they begin asking how much they can use to acquire assets. The objective becomes creating a financial structure in which assets gradually generate income. This requires patience because building assets usually takes time. A person may begin with a small amount of money. They may not be able to buy a large investment or start a major company immediately. But the important principle is to develop the habit of acquiring assets rather than spending every additional rupee or dollar on consumption. The lesson emphasizes that financial independence is often built through repeated decisions rather than one dramatic event. A person receives income. They pay necessary expenses. They allocate part of what remains towards assets. Those assets may eventually produce income. That additional income can then be used to acquire more assets. Over many years, this process can create a significant difference.
The opposite pattern can also develop. A person receives a higher salary, upgrades their lifestyle, takes on more debt, buys more expensive possessions, and increases their monthly expenses. Because their expenses rise along with their income, they remain dependent on their job. This is why earning more money is not necessarily the same as becoming wealthy. The lesson also discusses the importance of distinguishing between assets and liabilities. An asset, in the framework being presented, is something that contributes money to your pocket. A liability takes money out. The practical challenge is therefore to increase the number and quality of assets you own while controlling the liabilities that consume your income. This sounds straightforward, but everyday life makes it difficult. People naturally want comfort and status. When they earn more, they often want a better car, a larger house, expensive vacations, fashionable clothes, or other signs that they are becoming successful. There is nothing inherently wrong with enjoying these things. The problem arises when consumption becomes the primary destination of increasing income. A financially disciplined person learns to delay some consumption in order to strengthen their financial position first. This does not mean living an unhappy life or refusing to spend money. It means understanding priorities. If a person buys a luxury car using borrowed money, the car may create a significant monthly expense. If instead they use some of their money to build an income-producing asset, that asset may eventually help pay for the things they want. The difference is subtle but powerful. One approach makes the person more dependent on their income. The other can gradually make the person less dependent on their income. This is why the lesson encourages people to work for their profession while building their own asset column on the side. Another important idea is that people often work extremely hard for companies, governments, and financial institutions without realizing that they are building wealth primarily for other organizations. An employee works for a company and receives a salary. A portion of that salary goes towards taxes. Another portion may go towards interest on loans. Another portion goes towards consumption. The employee may work for decades without building enough independent assets to support themselves. The lesson asks readers to become more conscious of this pattern. Rather than simply working harder, people should ask themselves whether their work is helping them build something they own. This does not necessarily mean owning a traditional business. Someone does not need to become an entrepreneur in the conventional sense to apply the principle. The underlying idea is ownership of productive assets. For example, a person may have a career while building investments over time. Another person may develop intellectual property. Someone else may create a side business. Another may acquire income-producing property. The specific asset can differ, but the principle remains the same. Build something that can generate value independently of your daily labor. The lesson also warns against spending too much energy trying to look rich. There is a significant difference between appearing wealthy and actually becoming financially independent. A person wearing expensive clothes and driving an expensive car may look successful, but those possessions do not necessarily indicate financial strength. In fact, if they were purchased through heavy borrowing, they may represent financial pressure. Someone quietly accumulating productive assets may look much less impressive. They may drive an ordinary car and avoid unnecessary spending, yet their financial position could be far stronger because their money is being directed towards assets rather than appearances. This leads to an important psychological shift. Financial independence requires learning to separate genuine wealth from the appearance of wealth. The lesson also recognizes that people often use their jobs to finance their lifestyles rather than their futures. Once a person gets a raise, they may immediately increase their spending. This creates what can be described as lifestyle inflation. Instead of allowing increased income to strengthen their financial position, they allow it to increase their monthly obligations. The result is that the person may earn significantly more than they did years earlier but still feel financially pressured. The solution is not necessarily to reject higher income. Higher income can be extremely useful. The key is what happens to that additional income. If every increase disappears into consumption, the financial situation may remain unchanged. If part of the increase is consistently directed towards assets, the person's financial foundation can gradually become stronger. This is where discipline becomes important. Financial independence is not simply a matter of intelligence. A person may understand the difference between assets and liabilities but still make poor decisions because they cannot control their spending. Knowledge provides the map, but behavior determines whether the person follows it. The lesson therefore encourages a mindset of long-term thinking. Instead of asking, what can I buy with this money today, a person begins asking, what can this money become if I use it intelligently? A small amount invested in a productive asset may seem insignificant at first, but repeated over many years, those decisions can become meaningful. The same is true of poor financial decisions. One unnecessary expense may not destroy a person's finances, but years of unnecessary consumption and debt can create a powerful negative effect. Another important aspect of this lesson is that people should become responsible for their own financial future. Depending entirely on an employer, a government pension, or someone else to provide financial security can leave a person vulnerable to circumstances beyond their control. Building personal assets creates another layer of security. This does not mean that employment, pensions, or other forms of income are worthless. Rather, the idea is to avoid having only one financial foundation. A person who has a profession plus a growing portfolio of assets has more options than someone whose entire financial life depends on one paycheck. The ultimate objective is therefore financial independence, the point at which your assets generate enough income to cover your necessary expenses. At that stage, work can become a choice rather than an absolute necessity. That is one of the deepest ideas in this lesson. The goal is not simply to become rich so that you can stop working. Instead, the goal is to create enough financial strength that you have greater control over how you spend your time. You can continue working because you enjoy your profession, because you want to create something meaningful, or because you simply choose to. The difference is that you are no longer working solely because you are terrified of running out of money. The lesson therefore connects strongly with the earlier discussion about fear. When a person has no assets and depends entirely on employment, the fear of losing a job can be enormous. But as assets grow, dependence on a single paycheck can gradually decrease. This changes the psychological relationship with work. A person can begin thinking about work as an opportunity to learn, create, and contribute rather than simply as a way to survive financially. The larger message is that everyone has a financial life, whether they actively manage it or not. The question is whether they are consciously building that financial life or simply allowing their income to disappear into expenses. The lesson encourages readers to start small, remain patient, and focus on acquiring productive assets. It does not promise instant wealth. Instead, it presents wealth building as a long-term process that requires knowledge, discipline, and consistent action. Ultimately, the most important change is a change in perspective. Your job provides your current income. Your assets build your financial future. Once this distinction becomes clear, a person can continue pursuing their career while simultaneously building their own independent financial foundation. They no longer see their paycheck as the final destination of their work. Instead, they see it as a resource that can be directed towards building something of their own. The lesson can therefore be understood as a call to take ownership of your financial future. Work hard at your profession, but do not allow your entire financial life to depend on it. Use the income you earn to gradually build assets. Learn to distinguish productive assets from expenses that simply consume your money. Resist the temptation to measure success through possessions alone. Over time, the objective is to move from a situation where you work for money towards one where your assets work for you. That shift is at the heart of the lesson. It is not about quitting your job tomorrow, becoming an entrepreneur overnight, or becoming wealthy instantly. It is about beginning to build something that belongs to you financially while you continue earning and living your ordinary life. The person who understands this principle starts looking at every paycheck differently. Instead of seeing it only as money available for spending, they see it as an opportunity to strengthen their financial future. And with enough time, discipline, and financial knowledge, those small decisions can gradually create the independence that a salary alone may never provide.
The fourth major lesson shifts attention from personal spending and asset building to a subject that affects almost every working person: taxes, businesses, and the way wealthy people structure their finances. The central idea is that financial success is influenced not only by how much money a person earns, but also by how much of that money they are able to keep and how intelligently they organize their financial affairs. The lesson begins by looking at the history of taxation. Kiyosaki explains that taxes were not always a permanent feature of everyday life in the way many people experience them today. In various countries, governments introduce taxes for specific purposes, often during times of war or financial difficulty. Over time, taxation became a regular source of government revenue. The important point for Kiyosaki is not simply the history itself. He uses it to demonstrate that tax systems are created through laws, and therefore, people who understand those laws can often make better financial decisions than people who ignore them. This leads to a major contrast between financially educated and financially uneducated people. A person may work extremely hard to earn money but know very little about taxation. They receive their salary, taxes are deducted, and they use whatever remains to pay their expenses. Their financial decisions are often made after taxes have already reduced their income. Business owners and investors, however, may have access to different legal structures and deductions depending on the country and circumstances. They can sometimes organize their income and expenses differently because the tax system treats different forms of income and ownership differently. Kiyosaki uses this difference to make a broader argument. Financial education includes understanding the rules of the financial system. If you do not understand the rules, you may spend your entire life playing the game without knowing how it works. One of the most important concepts introduced here is the role of a corporation. Kiyosaki explains that corporations are often misunderstood. Many people imagine that corporations are simply huge companies owned by extremely wealthy individuals. In reality, a corporation can be a legal structure used to conduct business and organize financial activities. The important point is that a corporation is not necessarily the same thing as a large physical organization filled with thousands of employees. A small business can also operate through a corporate or other legal structure, depending on local laws. Kiyosaki argues that wealthy people often use legal structures strategically to protect assets, organize businesses, and manage taxes within the law. This creates a contrast with employees. An employee generally earns income first, has taxes deducted, or pays taxes on that income, and uses the remaining money for expenses. In simplified form, the sequence is often income, taxes, expenses. A business owner may have a different structure where legitimate business expenses are accounted for before determining taxable income, depending on the applicable tax rules. In simplified form, Kiyosaki presents the idea as income, expenses, taxes. The exact tax treatment depends on the jurisdiction and the nature of the business, so this should not be interpreted as a universal rule. The larger lesson is about understanding how legal financial structures affect cash flow. This distinction is central to Kiyosaki's argument because he believes that many people work hard to earn money without learning how the financial system treats different types of income.
Someone might spend years trying to increase their salary by a small percentage while paying little attention to how their income is taxed, how their expenses are structured, or how they can build assets. The financially educated person thinks about all of these factors together. This is why financial literacy becomes so important. Knowing how to earn money is only one part of financial intelligence. A person also needs to understand how money is protected, invested, taxed, and multiplied. The lesson then introduces another important concept, the power of corporations to protect wealth. Historically, corporations developed partly because people needed legal structures that separated business activities from the personal identity of the owners. A corporation can own property, enter contracts, and conduct business separately from its individual owners, subject to the laws governing it. Kiyosaki argues that wealthy people have historically used such structures to their advantage. The average employee may know very little about these structures, while wealthy individuals often surround themselves with accountants, lawyers, and financial advisors who understand the rules. This does not mean that every wealthy person avoids taxes or that corporations automatically eliminate taxes. Kiyosaki's broader point is that knowledge of the rules creates options. A financially uneducated person may see taxes as something completely outside their control. A financially educated person asks different questions. What type of income am I earning? What expenses are legitimate and necessary? What legal structure is appropriate? How are investments taxed? What financial decisions can improve my long-term position? These questions do not guarantee wealth, but they encourage a person to think strategically rather than passively. The lesson also returns to the idea of assets and liabilities. Building assets is important, but owning assets without understanding the cost and taxes associated with them can create problems. Financial decisions cannot be judged only by the purchase price. A person must consider ongoing expenses, taxes, maintenance, debt, and potential income. This reinforces the idea that financial intelligence is about seeing the entire picture. A financially educated person does not simply ask, "Can I afford to buy this?" They ask, "What will this purchase do to my cash flow?" They ask, "Will it produce income or consume income?" They ask, "What are the long-term costs?" They ask, "What are the tax consequences?" This way of thinking separates financial decisions from emotional decisions. The lesson also discusses the relationship between wealth and power. Kiyosaki suggests that wealthy people are often powerful because they understand how systems work. Their advantage is not necessarily that they are smarter in every area. Instead, they may understand financial, legal, and business systems better than the average person. For example, a highly educated employee may be an expert in medicine, engineering, or another profession, but have little knowledge about accounting and taxation. Meanwhile, a business owner may have less formal education but possess strong financial knowledge. This reinforces one of the recurring themes. Traditional education and financial education are not the same thing. A person can be academically brilliant and financially inexperienced at the same time. The lesson does not suggest that academic education is unimportant. Instead, it argues that education should extend beyond professional qualifications. If a person wants to become financially independent, they should also learn about accounting, investing, taxation, business structures, and financial strategy. Accounting becomes particularly important because it teaches people to understand numbers rather than simply trust appearances. A person may say, "My business is making a lot of money," but an accountant would ask, "How much revenue? How much profit? What are the expenses? What are the liabilities? What taxes are owed? What is the cash flow?" Similarly, someone may say, "I own a valuable house." Financial analysis asks, "What does it cost? How much debt is attached to it? What income does it generate? What happens to its value and cash flow over time?" This numerical way of thinking helps people avoid being fooled by appearances. The lesson also highlights the importance of legal protection. Wealthy individuals often protect themselves by using professional advisors and appropriate legal structures. They understand that making money is only one part of wealth creation. Protecting what you have built is another part. For Kiyosaki, this is one reason financially successful people may have teams around them. Accountants, lawyers, investment professionals, and other experts can help them navigate complex financial decisions. The average person, by contrast, may try to handle everything alone, or may not realize that such professional knowledge exists. This does not mean that every wealthy person needs an expensive team of advisors. The deeper lesson is to recognize the value of specialized knowledge, and to learn enough yourself to ask good questions. The chapter also carries an important warning. Financial intelligence must be used responsibly and legally. Understanding taxes does not mean cheating on taxes. Understanding corporations does not mean using them to deceive people. Understanding financial rules does not mean breaking them. The lesson is about learning the legal system and using available structures intelligently. This distinction is important because there is a major difference between tax planning and tax evasion. Legal tax planning involves arranging financial affairs within the law. Tax evasion involves deliberately breaking the law or concealing information. The lesson's emphasis is on knowledge and lawful strategy. Another important point is that the wealthy often focus on keeping and growing money, not simply earning it. Imagine two people who both earn the same amount. One person spends nearly everything after taxes and accumulates consumer debt. The other person controls expenses, builds assets, and understands how their investments and business activities are structured. Their incomes may initially be identical, but their financial futures can become dramatically different. This is why Kiyosaki continues to invest financial education. Income is only one part of the equation. The expenses matter, assets matter, liabilities matter, taxes matter, legal structures matter, investment knowledge matters. Together, these factors determine how much financial freedom a person can ultimately achieve. The lesson therefore encourages readers to stop thinking about money in a narrow way. Financial intelligence is not simply knowing how to earn a salary. It is understanding the entire journey of money from the moment it enters your life to the moment it is spent, invested, taxed, or passed on. The person who understands this process has more control. The person who ignores it may spend their entire life working harder without necessarily becoming financially stronger. One of the deeper messages is that the financial system rewards knowledge. People who understand how taxes, corporations, investments, and accounting work can make decisions that others may never even consider. This does not mean that the system is always fair or that everyone starts with the same opportunities. Kiyosaki's point is more practical. If you want to improve your financial position, learning the rules is more useful than simply complaining about them. The lesson therefore brings together several ideas introduced earlier. First, people should understand the difference between assets and liabilities. Second, they should build their own asset column. Third, they should understand where their money goes. Now they are encouraged to understand the broader financial system surrounding those decisions. The result is a more complete picture of financial independence. You earn money through your profession. You use part of that income to acquire assets. You manage your expenses and liabilities. You understand taxation. You learn about appropriate legal and business structures. You protect what you build. And gradually you create a financial system that does not depend entirely on your salary. The deepest lesson isn't a fraud about financial intelligence as a form of power. Money itself does not automatically create freedom. Knowledge about money creates choices. The more a person understands about accounting, taxation, investing, and business, the more intelligently they can respond to financial opportunities and problems. A person who understands only their paycheck may spend their entire life trying to increase that paycheck. A person who understands the larger financial system can begin thinking about income, assets, taxes, expenses, and ownership as parts of one connected picture. Ultimately, the lesson encourages viewers to become students of money. Instead of assuming that financial matters are too complicated, that accountants and lawyers should handle everything, a person should develop enough understanding to make informed decisions. The goal is not to become an expert in every financial field. The goal is to become financially literate enough to recognize opportunities, understand risks, and ask the right questions. The lesson ends with a powerful shift in mindset. Wealth is not only about how much you earn, it is also about how effectively you understand and control the financial system surrounding your money. Once a person understands that, earning money becomes only the beginning. The real challenge is learning how to keep it, protect it, grow it, and use it to create greater financial independence.
The fifth major lesson takes the idea of financial independence one step further. Up to this point, the discussion has focused on learning how money works, understanding assets and liabilities, building your own asset column, and becoming familiar with taxes and business structures. Now the focus shifts toward a quality that can make all of those ideas useful in the real world, the ability to recognize and create opportunities. The central message is that wealthy people do not necessarily become wealthy because they possess more money at the beginning. Very often, they become wealthy because they know how to find opportunities, solve problems, and turn ideas into financial value. This is why the lesson focuses on the idea of inventing money. When people hear the phrase making money, they often imagine receiving a salary, getting a promotion, starting a conventional business, or investing savings. These are familiar methods. But there is another way of thinking about money. Instead of waiting for an opportunity to appear, a financially intelligent person learns how to create opportunities. This does not mean creating money literally or producing currency. It means finding ways to create financial value through knowledge, creativity, timing, negotiation, and problem solving. Kiyosaki argues that opportunities exist everywhere, but many people fail to see them because they are not financially prepared to recognize them. Two people can look at exactly the same situation and see completely different things. One person may see a problem, another may see a business opportunity. One person may see a declining property, another may see a property that could be improved and made more valuable. One person may see a complicated investment, another may see a chance to learn something and potentially earn a return. The difference is not necessarily intelligence in the traditional academic sense. It is often financial intelligence and experience. This is why the lesson connects closely with the importance of financial education. If a person understands assets, liabilities, cash flow, markets, and business principles, they can evaluate opportunities more effectively. Without that knowledge, opportunities can look like risks. A person may see a situation that requires effort, uncertainty, and learning and immediately reject it. Someone with greater financial understanding may investigate further and discover that the same situation contains significant potential. However, this does not mean every opportunity is good. Financial education also involves knowing when to say no. The ability to recognize an opportunity must be combined with the ability to evaluate risk. This becomes one of the important themes of the lesson. Financial intelligence is not simply about taking risks, it is about learning how to manage and understand risks. Many people avoid investing or entrepreneurship because they believe that wealthy people are simply willing to take huge risks. Kiyosaki presents a different interpretation. He suggests that people who appear to take large risks actually understand the situation better than outsiders realize. For example, someone who has studied a particular market for years may recognize an opportunity that looks dangerous to someone without experience. The experienced person may understand the potential risks, the possible returns, and the ways to protect themselves if things go wrong. The inexperienced person sees uncertainty. The financially educated person sees a situation that can be analyzed. This difference in perception is extremely important. The lesson also emphasizes the role of financial creativity. When people encounter a financial problem, they often look for the most obvious solution. If they need more money, they may search for another job. If they want a better lifestyle, they may seek a higher salary. If they want to buy something, they may borrow money. Financially creative people ask different questions. Is there another way to structure the deal? Can the problem be solved without taking on unnecessary debt? Can an asset be acquired at a discount? Can something be improved and sold or rented for more? Can an existing skill be turned into an additional source of income? Can two different opportunities be combined?
This way of thinking can create possibilities that are invisible to someone who only thinks in terms of salary. The lesson therefore encourages people to develop creative financial thinking. One of the reasons many people remain financially dependent, according to this perspective, is that they have been trained to look for one correct answer. Traditional education often rewards students for finding the answer expected by the teacher. Real financial situations are different. There may be several possible solutions, and the best solution may not be obvious. A financially intelligent person needs to be comfortable with uncertainty, research, and experimentation. This does not mean acting recklessly. It means being willing to learn. The lesson also discusses the importance of timing. Opportunities do not always appear when a person feels completely prepared. Sometimes an opportunity appears before someone has enough confidence, experience, or money to take advantage of it. This can create a difficult decision. Should the person wait until everything is perfect, or should they learn quickly enough to determine whether the opportunity is worth pursuing? The lesson suggests that financial education can help reduce this uncertainty. The more a person understands, the better equipped they become to evaluate situations. This is why Kiyosaki places such strong emphasis on learning continuously. A person who stops learning may become financially outdated. Markets change, technologies change, businesses change, tax laws change, consumer behavior changes, new industries emerge while old industries decline. Someone who continues learning can adapt. Someone who relies only on an old source of income may become vulnerable if circumstances change. This idea is particularly important in a world where traditional employment is not always guaranteed. A person may have a good career today but face unexpected changes tomorrow. Companies restructure, industries disappear, technology replaces certain tasks, and economic conditions change. Financial intelligence gives a person additional options. Instead of having only one source of income, they can gradually develop investments, businesses, skills, or other assets. The lesson also emphasizes the importance of information. Information can create an advantage when it allows a person to understand something before others do or evaluate it more accurately. For example, someone who understands a particular industry may notice a trend before a person outside that industry. Someone with knowledge of property markets may recognize an undervalued opportunity. Someone skilled in technology may identify a useful development before it becomes widely adopted. The ability to recognize value often comes from accumulated knowledge. This is why education is not presented as something that ends when school ends. Financial education continues throughout life. Another important idea is that people should not simply look for opportunities that require money. Sometimes opportunities can be created through skills. A person might know how to sell, negotiate, manage people, analyze numbers, build systems, communicate effectively, or solve technical problems. Those skills can create financial value. This connects to an important principle: money follows value. If a person can solve a problem that others are willing to pay to have solved, they can potentially create income. The challenge is identifying the problem, understanding the market, and delivering a solution effectively. This is very different from simply exchanging time for wages. An employee may be paid for the number of hours worked. An entrepreneur or investor may create something that produces value repeatedly. Again, this does not mean that employment is inferior. Employment can provide stability, experience, training, and income. But the lesson encourages people to develop the ability to create value beyond their immediate labor. The concept of leverage also becomes relevant here. A person can use knowledge, technology, systems, other people's expertise, or capital to accomplish more than they could accomplish through their own effort alone. For example, an individual working alone has a limit to how many hours they can work. A business with systems and employees can potentially serve many more customers. A digital product can potentially be sold repeatedly without requiring the creator to reproduce the entire product each time. Investment can also provide leverage because capital can generate returns without requiring the investor to personally perform every task involved. The important lesson is to understand how systems can multiply effort. However, leverage can work in both directions. Used intelligently, it can increase opportunities. Used carelessly, it can increase losses. This is when knowledge and risk management remain essential. The lesson also challenges the belief that a person must have a large amount of money before they can begin building wealth. Someone with very little money may assume that investing or entrepreneurship is impossible. But Kiyosaki's perspective suggests that financial intelligence can itself be a form of capital. Knowledge can help someone identify a valuable opportunity. Creativity can help them structure a deal. Negotiation skills can help them improve the terms. Research can help them avoid a bad investment. Experience can help them recognize warning signs. In this sense, money is not the only resource available to a person. This is particularly important because many people focus exclusively on how much money they have while ignoring what they know. Someone may have a small amount of capital but excellent knowledge. Another person may have a large amount of capital but poor financial judgment. The second person can potentially lose money because they do not understand what they are doing. The first person may gradually increase their financial position because they know how to find and evaluate opportunities. The lesson therefore encourages readers to invest in their own financial intelligence. This means learning about investing, business, accounting, economics, negotiation, and markets. It also means learning from mistakes. Failure becomes part of the educational process. Someone who tries something financially and fails may feel embarrassed or discouraged, but if they analyze what happened, they can gain knowledge that may prevent the same mistake in the future. The greater danger from this perspective is not making a mistake. It is refusing to learn from mistakes. Fear of failure can prevent people from taking even reasonable opportunities. They may remain in situations they dislike simply because those situations feel familiar. Financial creativity requires a willingness to experiment carefully, evaluate results, and adjust. The lesson also emphasizes that opportunities are often created during difficult times. When markets fall, businesses struggle, or economic conditions become uncertain, many people become frightened. They want to protect what they already have. A financially educated person may also recognize that difficult periods can create situations in which certain assets become undervalued or businesses need new solutions. Again, this does not mean that every downturn is an opportunity, or that people should blindly buy during difficult times. The point is that financial intelligence allows a person to examine circumstances objectively, rather than reacting only to fear. This connects directly to one of the strongest themes running through these lessons. Emotions can interfere with financial judgment. Fear can make people miss opportunities. Greed can make people take excessive risks. Pride can prevent people from admitting they do not understand an investment. Impatience can lead people to expect immediate results. Financial intelligence requires emotional discipline as well as technical knowledge. The lesson therefore presents wealth creation as a combination of knowledge, creativity, courage, and discipline. A person needs knowledge to understand an opportunity. They need creativity to structure a solution. They need courage to act when the opportunity is reasonable. They need discipline to manage the risks. and they need patience to allow the results to develop. Perhaps the most important lesson is that wealth is often created by solving problems in ways that other people have not considered. The financially successful person does not necessarily wait for someone to offer them a better salary. They look for ways to create value. They may buy, improve, and sell something. They may develop a business. They may invest in an opportunity they understand. They may use technology to create a scalable product. They may find a more efficient way to solve an existing problem. The specific method can vary enormously. What remains constant is the mindset of looking for possibilities rather than simply waiting for opportunities to arrive. This lesson therefore expands the definition of financial intelligence. It is not merely knowing how to read financial statements or distinguish assets from liabilities. It is also the ability to see financial possibilities where other people see only ordinary situations. A person who develops this ability becomes less dependent on a single path to financial success. They can continue working in their profession while learning to invest. They can develop new skills. They can build a side business. They can study markets. They can meet people who possess knowledge they do not have. They can gradually develop the ability to create and recognize opportunities. The ultimate goal is not to become wealthy through luck. It is to become capable of recognizing opportunities when they appear. Luck may still play a role in financial success, but preparation determines whether a person can take advantage of that luck. An opportunity may appear in front of two people. One may not recognize it. The other may understand its potential immediately because they have spent years learning. The opportunity itself may be identical. The difference is preparation. This is why the lesson ultimately returns to education. Financial education changes what a person can see. The more financially knowledgeable someone becomes, the more possibilities they can evaluate. Instead of seeing money as something that must always be earned through more hours of work, they begin seeing money as a resource that can be directed, invested, and multiplied. Instead of asking only where can I get more money, they begin asking what problem can I solve, what opportunity can I create, and how can I make my resources work more effectively. That is the deeper meaning of the lesson. Financial independence requires more than saving money and working hard. It requires the ability to think creatively about money. The person who develops that ability can begin creating opportunities rather than waiting for them. Ultimately, the lesson teaches that financial intelligence can turn limited resources into greater possibilities. Money is useful, but knowledge, creativity, and the ability to recognize value can sometimes be even more important. The goal is therefore not simply to accumulate money. It is to become the kind of person who understands how opportunities are created, how risks are evaluated, and how financial value can be generated. Once that mindset develops, a person no longer sees the financial world as a fixed system in which they must simply accept whatever income is offered to them. They begin to understand that there are many ways to create value, build assets, and improve their financial position. And that is what makes this lesson so important. Sometimes the greatest financial asset a person can develop is the ability to see an opportunity that others cannot seize.
The sixth major lesson takes the idea of financial independence in a different direction. Instead of focusing primarily on how much money a person earns, it asks a more important question. What are you learning from the work you do? The central message is that people should not choose work only for the salary it provides. Work can also be a form of education. The skills, experience, and knowledge gained through different jobs can become extremely valuable later in life. In this sense, a person should sometimes be willing to work for learning and development, rather than choosing every opportunity based purely on immediate financial reward. This idea comes from the different attitudes of the two father figures. One places great importance on getting a secure profession and earning a good salary. The other places greater emphasis on developing a wide range of skills. The second approach encourages a person to become capable in several areas rather than becoming extremely specialized in only one. The reason is simple. Financial success often requires the ability to understand several parts of a business or financial system at the same time. Someone may be excellent at engineering but know nothing about sales. Someone may be a talented writer but have no understanding of accounting. Someone may understand technology but struggle to communicate with customers. Someone may know how to produce a product but have no idea how to market it. Each of these people possesses valuable knowledge, but their lack of other skills can limit their ability to create financial opportunities. The lesson therefore argues for breadth of knowledge. Instead of spending an entire career becoming highly specialized in one narrow area, a person can deliberately develop skills across different fields. This does not mean becoming an expert at everything. It means understanding enough about different functions to communicate, make decisions, and recognize opportunities. One of the most important areas discussed is sales. Many educated people dislike the idea of selling. They may associate sales with pressure, persuasion, or manipulation. They may believe that sales is beneath them or that their professional qualifications should speak for themselves. But Kiyosaki presents sales as an essential skill because almost every career involves some form of selling. A person may need to sell an idea to a manager. An entrepreneur must sell a product or service. A job applicant must sell their abilities to an employer. A leader must persuade people to support a vision. An investor must communicate effectively with partners. Even a highly skilled professional needs to communicate the value of their work. Therefore, learning how to communicate and sell can dramatically increase a person's effectiveness. The lesson also highlights communication more broadly. A person may have excellent technical knowledge, but if they cannot communicate that knowledge clearly, their opportunities may remain limited.
This is why Kiyosaki encourages people to develop skills that traditional education may not always emphasize strongly enough. Leadership, communication, sales, marketing, accounting, and negotiation can all contribute to financial success. The important point is that these skills work together. Imagine someone who has developed an excellent product but cannot sell it. Their technical ability alone may not produce a successful business. Now imagine someone who can sell extremely well but does not understand accounting. They might generate large revenues while making poor financial decisions. A successful entrepreneur or financially independent person often needs to understand multiple parts of the process. This is why the lesson encourages people to become well-rounded. The idea of working to learn also changes the way a person evaluates a job. Most people ask, how much does this job pay? The lesson encourages another question, what will this job teach me? A position that pays slightly less but provides valuable experience in sales, management, or business operations might potentially be more valuable in the long term than a higher-paying position that teaches the person very little. This is a difficult idea because immediate income matters. People have bills to pay, families to support, and financial responsibilities. The lesson does not suggest that salary should be ignored completely. Instead, it suggests that people should consider the long-term value of skills alongside immediate compensation. A person might accept a job because it gives them access to knowledge that they can later use to create their own business. Someone interested in entrepreneurship might deliberately work inside a company to understand how that company operates. They may learn about inventory, customer service, marketing, hiring, accounting, or management. Later, those skills can become the foundation for their own enterprise. In this way, employment becomes a training ground. The job is no longer merely a place where the person exchanges time for money. It becomes a place where they acquire capabilities. This idea is particularly important for young people who are still developing their careers. The first job does not have to be the final destination. It can be an opportunity to learn what works, what does not work, and what skills are valuable. The lesson also discusses the danger of specialization without financial knowledge. Modern education often encourages specialization. People are trained to become doctors, engineers, accountants, lawyers, technicians, and other professionals. Specialization can produce expertise and higher earning potential. But financial independence may require something different. A person can become highly successful professionally while remaining financially dependent because they never learned how money works. For example, a doctor may earn a large income but have little understanding of investing. A lawyer may have a successful career but struggle with managing personal debt. An engineer may have a high salary but spend everything they earn. Professional success and financial success are related, but they are not identical. This is why the lesson argues that people should develop a financially useful combination of skills. Technical knowledge helps a person produce something valuable. Communication helps them explain it. Sales helps them persuade others to buy or support it. Marketing helps them reach customers. Accounting helps them understand the financial results. Management helps them organize people and resources. Negotiation helps them improve agreements. Investing knowledge helps them use profits to build assets. When these skills come together, a person becomes much more capable of creating financial opportunities. Another important idea is that people should learn to work with different types of people. In the workplace, individuals may encounter people who think very differently from them. Some are analytical, others are creative. Some are excellent communicators, others are highly technical. Some are natural leaders, while others prefer to work independently. A financially capable person needs to learn how to cooperate with different personalities and areas of expertise. This is especially important in business because successful organizations usually require many different skills. One person rarely possesses all of them. The ability to build relationships and work with others can therefore become an important financial asset. The lesson also encourages people to learn from experience rather than waiting for perfect conditions. A person may think they need to know everything before trying something new. But complete knowledge is rarely possible. Experience itself becomes a teacher. Someone who works in sales learns how customers think. Someone who works in management learns how organizations function. Someone who works in accounting learns how money moves through a business. Someone who works in marketing learns how attention is created. Someone who works in customer service learns what customers actually want. Each experience adds another piece to the larger picture. Over time, these pieces can combine into a powerful understanding of business and money. This is why the lesson places such a high value on learning across different departments and industries. A person may intentionally change jobs or responsibilities, not because they are dissatisfied with their career, but because they want to acquire a skill they currently lack. This can require courage because society often encourages people to follow a straight career path. People are told to choose one profession, specialize, and remain in that field. Kiyosaki challenges this idea by suggesting that a person's career can be viewed as a collection of learning experiences. The goal is to build a portfolio of skills. A person who knows only one thing extremely well may be vulnerable if that particular skill becomes less valuable. A person who has multiple complementary skills can adapt more easily. This becomes increasingly important as technology and industries change. A person who has learned how to learn can respond to change more effectively than someone who depends entirely on one established skill. The lesson also touches on the importance of leadership. Leadership is not simply about having authority. It is about understanding people, making decisions, accepting responsibility, and creating direction. Someone who wants to build a business or manage investments eventually needs to make decisions that affect other people and resources. Therefore, leadership becomes another valuable form of education. The same is true of negotiation. Financial outcomes are often influenced by the terms of an agreement. The ability to negotiate can affect salaries, business deals, investments, purchases, and partnerships. Someone who knows how to negotiate effectively may be able to create better opportunities without necessarily having more money than the other person. Again, this illustrates the central theme. Skills can create financial value. The lesson also warns against becoming trapped by the pursuit of a high salary. A high salary can provide comfort, but it can also create dependence. If someone becomes accustomed to a particular lifestyle, they may be afraid to leave their job even when they dislike it. They may feel that they cannot afford to change careers because their current income supports their expenses. This can create another form of the rat race. The person earns more but becomes increasingly dependent on maintaining that income. Working to learn offers another possibility. A person can deliberately acquire skills that eventually give them more choices. The more valuable and versatile their skills become, the more opportunities they may have. This does not guarantee success, but it can increase flexibility. The lesson also highlights the importance of personal development. Financial independence is not only about acquiring external assets. A person's knowledge, experience, and abilities are themselves valuable resources. Money can be lost, businesses can fail, markets can decline, jobs can disappear, but the skills a person has developed can continue to create opportunities throughout their life. This makes running one of the most durable investments a person can make. The deeper message is that people should think of their career strategically. Instead of asking only, how much money can I earn right now, they can ask, what skills will make me more valuable 5 or 10 years from now? That question changes the entire approach to career development. Someone might temporarily accept a challenging role because it gives them management experience. Another person might learn sales even though their main interest is investing. Someone else might study accounting because they want to understand businesses more deeply. Another might develop communication skills because they know that leadership requires the ability to influence and explain. Each skill becomes another tool in the person's financial toolkit. This also explains why the lesson does not simply encourage people to become entrepreneurs immediately. Entrepreneurship requires a combination of abilities. Without sales, communication, financial knowledge, and management skills, starting a business can become extremely difficult. Working in different environments can provide a safer way to acquire those skills before taking larger risks. The ultimate objective is freedom through capability. The more useful skills a person develops, the more choices they may have. They can change jobs. They can start a business. They can negotiate better opportunities. They can manage investments more intelligently. They can lead teams. They can communicate effectively. They can recognize business opportunities. They can adapt when circumstances change. In this sense, the real value of working to learn is that it increases a person's future options. The lesson therefore challenges the common definition of career success. Success is not necessarily reaching the highest salary as quickly as possible. Sometimes success means becoming more capable. A person who earns a large salary but learns very little may eventually become financially trapped. A person who earns a reasonable income while deliberately developing valuable skills may create much greater opportunities over time. The key is to think beyond the immediate paycheck. This lesson ultimately brings together many of the ideas introduced earlier. Financial literacy teaches a person how money works. Building assets teaches them how to create financial independence. Understanding taxes and business structures teaches them how to organize and protect their finances. Developing financial creativity teaches them how to recognize opportunities. Now, developing a broad range of skills gives them the ability to act on those opportunities. The message is therefore simple but powerful. Do not let your career be measured only by the money it gives you today.
The seventh major lesson turns from financial knowledge toward one of the biggest reasons people fail to achieve financial independence: their own psychological and emotional obstacles. By this point, the importance of financial literacy, asset building, creativity, and learning has been established. But knowledge alone is not enough. A person can understand exactly what they should do and still fail to do it because fear, doubt, laziness, bad habits, or emotional reactions get in the way. This lesson is therefore about overcoming the barriers that stand between a person and financial success. One of the first obstacles is fear. Losing money is frightening, especially when someone has worked hard to earn it. Because of this fear, many people avoid investing or taking any financial risk at all. They prefer to keep their money in places that feel completely safe, even if those choices may not help them build long-term wealth. The problem is that avoiding every possible risk does not necessarily create financial security. Every financial decision involves some form of uncertainty. Keeping money in cash has risks, investing has risks, starting a business has risks, remaining dependent on one job also has risks. The goal, therefore, should not be to eliminate risk completely. The goal should be to understand and manage risk intelligently. A financially educated person understands that losing money is possible. Instead of allowing that possibility to create complete paralysis, they study the situation, calculate the potential downside, and decide whether the opportunity is worth pursuing. This is very different from blindly taking risks. The lesson emphasizes that successful investors can experience losses.
What separates them from people who repeatedly fail is often the ability to learn from those losses, rather than allowing one failure to end their financial journey. A person who loses money on an investment may become terrified and decide never to invest again. Another person may study what went wrong and become more knowledgeable as a result. The second person has turned a negative experience into education. This leads to another obstacle: cynicism and doubt. People often hear about opportunities and immediately explain why they will not work. They may say that the economy is too bad, the market is too dangerous, prices are too high, or wealthy people already control everything. Some caution is useful, but constant negativity can prevent a person from seeing genuine opportunities. The lesson encourages people to distinguish between healthy skepticism and destructive cynicism. Healthy skepticism asks questions. How does this investment work? What are the risks? What could cause the investment to fail? What evidence supports the opportunity? How can the downside be controlled? Cynicism, on the other hand, rejects an opportunity before investigating it. The difference is important because financial opportunities are rarely perfect. Every investment has uncertainty. If a person requires absolute certainty before acting, they may never act at all. Another major obstacle is laziness. This may sound surprising because many financially struggling people work extremely hard, but the lesson suggests that people can be busy without being financially productive. Someone may work long hours, constantly worry about money, and remain exhausted, yet never spend time learning how to improve their financial situation. Financial laziness can appear as avoidance. A person may avoid looking at their financial statements because the numbers make them uncomfortable. They may avoid learning about investing because it seems complicated. They may avoid examining their debts because they don't want to face the problem. They may avoid planning because thinking about the future feels overwhelming. In this sense, laziness is not always lying on the sofa and doing nothing. Sometimes it means avoiding the uncomfortable work of thinking. The lesson encourages people to become proactive. Instead of waiting for financial problems to disappear, they should confront them. Another obstacle is bad habits. Financial behavior is often determined by habits rather than knowledge. A person may know that saving is important but still spend impulsively. They may understand that debt is dangerous but continue borrowing for unnecessary purchases. Changing financial habits therefore becomes essential. One of the most useful habits is to pay yourself first. The idea is that when income arrives, a person should set aside money for savings and investments before allowing all of the money to disappear into expenses. This approach creates discipline. If someone waits until the end of the month to see what is left over, there may be nothing left. Expenses tend to expand until they consume whatever income is available. By prioritizing saving and investing first, the person forces themselves to manage the remaining money more carefully. This does not mean ignoring essential expenses or refusing to meet financial responsibilities. It means treating investment and financial development as priorities rather than whatever happens to remain after spending. Another obstacle is arrogance. A person may become successful in one area and assume that they understand everything. But financial markets, businesses, and investments can punish overconfidence. The financially intelligent person recognizes what they do not know. They ask questions, they seek advice, they study. They listen to people with greater experience. They remain willing to change their minds when new information appears. Arrogance can be particularly dangerous because it prevents learning. The lesson also emphasizes the importance of surrounding yourself with the right people. The people around us influence our thinking. If someone constantly spends money, complains about finances, and mocks investing, their attitude can influence our own behavior. On the other hand, being around people who are interested in learning, investing, and building businesses can expose us to different ways of thinking. This does not mean blindly following wealthy people or copying every financial decision someone else makes. It means being intentional about the ideas we allow to influence us. Another obstacle is disappointment. Financial progress is rarely smooth. Investments can fall. Businesses can fail. Deals can collapse. Plans can take longer than expected. A person who expects constant success may become discouraged after the first setback. The lesson encourages persistence. Failure does not necessarily mean that the entire strategy was wrong. Sometimes it simply means that something needs to be changed. A failed investment can teach an important lesson about research. A failed business can teach an important lesson about customers. A bad negotiation can teach an important lesson about preparation. The key is to analyze the experience rather than simply labeling it as failure. This leads to one of the most important qualities in financial success: persistence. Many people quit too early. They start saving and stop after a few months. They begin investing and become frightened when the market falls. They start a business and give up when the first idea doesn't work. They begin learning and abandon the process because it seems difficult. Building wealth often requires continuing long after the initial excitement disappears. Persistence does not mean stubbornly repeating the same mistake. It means remaining committed to the larger goal while being willing to change the method. This distinction is extremely important. A person should not keep doing something that clearly doesn't work simply because they want to appear persistent. Intelligent persistence means learning, adapting, and continuing. Another obstacle is fear of what other people think. Society often has strong opinions about money and careers. People may be expected to follow traditional paths. If someone chooses a different financial strategy, family members or friends may question them. They may hear statements such as, "Why don't you just get a secure job? Investing is too risky. Why do you want to start a business? Why don't you buy a bigger house? Everyone else is doing it." The lesson encourages people to think independently. This does not mean ignoring advice. It means learning to distinguish between advice based on knowledge and advice based on fear. Sometimes people discourage others from taking financial opportunities because they themselves are afraid. Their intention may be good, but their fear can become another person's limitation. The ability to think independently therefore becomes valuable. The lesson also emphasizes the importance of setting goals. Without a clear financial goal, people can easily lose direction. They may save without knowing why, invest without a plan, or work endlessly without defining what financial independence means to them. A goal gives financial decisions a purpose. For one person, the goal may be building enough investment income to cover basic expenses. For another, it may be owning a business. For someone else, it may be creating enough savings and investments to have greater career freedom. The specific goal is personal. What matters is having one. Another obstacle is temptation. When income increases, people naturally want to improve their lifestyle. But financial independence requires an ability to delay gratification. The person who spends every increase in income immediately may remain financially dependent. The person who uses part of every increase to build assets may gradually create greater independence. This does not mean never enjoying money. It means understanding the difference between rewarding yourself and sabotaging your future. The lesson therefore presents financial success as a psychological challenge as much as a mathematical one. Knowing what to do is only the beginning. The real challenge is controlling emotions, habits, and behavior long enough for good financial decisions to produce results. Ultimately, the lesson teaches that the biggest obstacle between a person and financial independence may not be a lack of money. It may be a lack of discipline, courage, patience, or willingness to learn. Fear can stop action. Cynicism can hide opportunities. Laziness can prevent learning. Bad habits can destroy progress. Arrogance can stop education. Disappointment can end persistence. The way forward is to recognize these obstacles and consciously develop better responses to them. The deeper message is that becoming financially independent requires becoming a different kind of thinker. A person must learn to tolerate uncertainty, accept mistakes, keep learning, and remain disciplined. Financial freedom is therefore not simply something a purchases with money. It is something they gradually build through knowledge, habits, emotional control, and consistent action. Chapter 8 Summary. The 8th major lesson changes the tone from explaining financial principles to discussing how a person can actually begin applying them. Knowing about assets, liabilities, investing, business, and financial literacy is valuable, but knowledge becomes useful only when it is converted into action. The central message is that a person does not need to wait until they are rich before they begin building wealth. They can start with whatever resources, skills, and knowledge they currently possess. The first step is to find a reason that is strong enough to keep you moving. Financial goals require motivation because the process can take years. Saving money, learning about investments, building assets, and controlling expenses may not provide immediate excitement. There will be moments when the sacrifices feel difficult. A strong personal reason can provide the motivation needed to continue. For some people, the motivation may be freedom. They want the ability to choose where they work and how they spend their time. For others, it may be security. They want to know that an unexpected job loss or financial emergency will not destroy their lives. For someone else, the motivation may be family. They want to create opportunities for their children or reduce financial pressure on their household. The specific reason does not matter as much as its emotional importance. Once a person knows why they want financial independence, they can begin creating a practical plan. One of the most important principles is to start small. People sometimes avoid investing or building assets because they believe they need a large amount of money. They imagine that financial independence begins only after they accumulate a large amount of capital. But the lesson encourages beginning with small steps. A person can begin by understanding their expenses. They can examine their financial statements. They can reduce unnecessary liabilities. They can begin saving regularly. They can study investments. They can develop a new skill. They can learn about businesses. They can begin building an asset column gradually. The first step does not have to be dramatic. What matters is creating momentum. The lesson also emphasizes the importance of education. Before investing money into something that you do not understand, learn about it. This principle protects people from many common mistakes. Financial markets contain opportunities, but they also contain risks. Someone who invests based on rumors, social media excitement, or someone else's recommendation may not understand what they are buying. Education allows a person to make decisions based on understanding rather than emotion. This is especially important because financial opportunities often appear attractive precisely when people are excited. A person may hear about an investment that has increased rapidly and feel pressure to participate immediately. But excitement is not analysis. The financially intelligent person slows down. They ask what creates the investment's value. They examine the risks. They investigate the numbers. They consider whether the price makes sense. They determine what could cause the investment to fail. Only after understanding the situation can they make a reasonable decision. Another important principle is to find people who can teach you. Learning from experience is valuable, but learning from people who have already made mistakes can save time. Mentors, experienced investors, entrepreneurs, accountants, and other knowledgeable people can provide perspectives that are difficult to develop alone. However,
The overall message of these lessons is that financial independence begins with a change in the way a person thinks about money. It is not simply a matter of earning a large salary, working harder, or accumulating expensive possessions. The deeper challenge is learning to understand money, control it, and eventually make it work for you. At the beginning of the journey, the most important realization is that income and wealth are not the same thing. A person can earn a high salary and still remain financially trapped if most of that income immediately disappears into expenses, debt, and lifestyle upgrades. On the other hand, someone with a modest income can gradually become financially stronger by controlling expenses and consistently building productive assets. This is why financial education becomes the foundation of everything else.
Without understanding assets, liabilities, cash flow, taxes, investing, and business, it is difficult to make intelligent long-term decisions. Education changes the way a person sees money. Instead of looking at a house, car, salary, or investment only through appearances, they begin asking what those things are actually doing to their financial position. The next important step is to stop thinking of a job as the entire financial plan. A profession can provide income, experience, and security, but depending completely on a paycheck can create vulnerability. The goal is to continue developing professionally while also building an independent asset base. Every paycheck can become more than money for immediate consumption. It can become a resource for creating future income. This requires discipline because one of the greatest obstacles to financial freedom is the tendency to increase spending whenever income increases. People naturally want better lifestyles, and there is nothing wrong with enjoying the rewards of hard work. But if every increase in income produces an equal increase in expenses, financial independence remains distant. The financially disciplined person learns to balance present enjoyment with future freedom. Another major lesson is that financial success requires emotional control. Fear can prevent people from taking reasonable opportunities. Greed can push them into excessive risk. Cynicism can make them reject opportunities without investigating them. Laziness can prevent them from learning. Arrogance can stop them from accepting advice. Impatience can cause them to abandon good strategies before they have time to work. Therefore, becoming financially intelligent is not simply about learning numbers. It is also about learning yourself. A person must understand their own habits, fears, and weaknesses. They must become comfortable with uncertainty and understand that mistakes are part of the learning process. A financial mistake does not necessarily mean that the journey has failed. If the mistake produces knowledge and changes future behavior, it can become valuable education. The lessons also emphasize the importance of developing multiple skills. A person should not measure every job only by its salary. Sometimes a job is valuable because of what it teaches. Sales, communication, leadership, negotiation, accounting, management, and technical knowledge can all become powerful tools. The more useful skills a person develops, the more opportunities they can recognize and create. This is especially important because financial opportunities are not always obvious. Two people can look at the same situation and see completely different possibilities. One may see only a problem, while another sees a business opportunity. One may see an expensive asset, while another sees a way to improve it and create value. The difference often comes from knowledge and experience. This is why continuous learning is so important. The financial world changes constantly. Industries change, technologies develop, markets move, and new opportunities appear. A person who continues learning can adopt. Someone who depends entirely on one old skill or one source of income may become increasingly vulnerable. Another powerful idea is that wealth is ultimately about freedom. Money itself is not necessarily the final goal. The deeper purpose of financial independence is the ability to make choices. When a person's assets generate enough income to cover their needs, they gain greater control over their time. They can choose whether to continue working. They can choose what kind of work they want to do. They can spend more time with family. They can pursue interests that may not provide immediate financial rewards. They can take opportunities without being completely controlled by the fear of losing their next paycheck. This is why financial independence is more meaningful than simply appearing rich. A person may own expensive things and still be financially stressed. Another person may live modestly while steadily building assets and financial security. The appearance of wealth can be very different from the reality of wealth. True financial strength is connected to control, cash flow, assets, and choices. The journey also requires patience. Wealth generally does not appear overnight. There may be years when progress seems slow. Small investments may not look impressive at first. Skills may take years to develop. Businesses may require repeated attempts. Financial knowledge grows gradually. But small decisions can become powerful when repeated consistently. One good financial decision may not change a person's life. 1 month of saving may not create freedom. One investment may not produce significant income. One new skill may not immediately increase earnings. But hundreds of good decisions made over many years can create an entirely different financial position. This is why the process matters more than the quick result. The most important transformation, therefore, is a transformation in thinking. Instead of asking only, how much money can I earn? A person begins asking, how can I use the money I earn to build assets? Instead of asking, can I afford this? They ask, what will this do to my cash flow? Instead of asking, how can I get a safer job? They ask, what skills can make me more valuable and less dependent on one employer? Instead of asking, what should I buy? They ask, what can I build? These questions lead to a completely different financial mindset. The ultimate lesson is not that everyone must become an entrepreneur, investor, or millionaire. Different people have different goals and circumstances. The deeper message is that everyone can benefit from becoming more financially educated and taking greater responsibility for their financial future. A person does not need to reject employment. They do not need to take reckless risks. They do not need to chase every investment opportunity. They do not need to become obsessed with money. Instead, they need to understand the role money plays in their life and make deliberate decisions about it. Financial freedom begins when money stops being something that controls every decision and becomes a tool that supports the life a person wants to create. In the end, the journey is about moving from dependence to independence, from fear to understanding, and from simply earning money to building financial capability. The most powerful asset a person can develop is not necessarily a property, stock portfolio, or business. It is the ability to think clearly about money, learn continuously, recognize opportunities, manage risk, and act with discipline. Once that ability develops, money becomes easier to understand. And when money becomes easier to understand, financial decisions become more intentional. That is where the real journey toward financial freedom begins.